Welcome to this explainer. Right now, there are these massive, frankly invisible forces actively reshaping global finance and, ultimately, your future. But here's the secret. Absolutely none of this is actually new. Today, we're going to expose the identical structural playbooks from history that are running right now in plain sight. Because if we really want to understand where the world is going, we have to look at the mathematical and architectural mechanisms that have already played out in the past.
Okay, let's just jump right in and look at the sheer scale of the stakes here. $36 trillion. That is America's current national debt. It's a number that's growing at 8% every single year, and just on that debt, the U.S. is paying over $1 trillion a year in interest alone. That's the macro environment we're operating in right now. I mean, this isn't just a big number. It's practically a gravitational pull that is forcing major global players to fundamentally change their strategies.
So, to make sense of all these complex shifts, we're going to follow a pretty straightforward agenda today. Number 1, the 1985 currency trap. 2, the 1944 reserve playbook. 3, the 1875 debt collapse. And finally, 4, the 1929 asset grab. Let's get right into it.
All right, starting off with Section 1, the 1985 currency trap and escaping the dollar squeeze.
To really grasp what's happening today, we actually have to rewind a bit to the 1985 Plaza Accord. Back then, Japan was this absolute export powerhouse, right? They were running a massive trade surplus with the US, and American political pressure was really mounting. So 5 finance ministers literally meet up at a hotel in New York and casually sign a coordinated agreement to deliberately weaken the US dollar. And the result? It was brutal. Before that meeting, $1 bought 240 yen. 18 months later, just 120. The yen doubled in value basically overnight, which suddenly made Japanese exports twice as expensive. This triggered a massive asset bubble and an eventual crash that plunged Japan into 30 years of economic stagnation. 5 guys, a hotel room, and an entire economy was just suffocated.
Now, this is where it gets super interesting for us today. Back in '85, Japan held $200 billion in U.S. debt, and they had absolutely no exit when that American financial pressure hit. Well, today, Chinese policymakers have clearly studied the Plaza Accord. They looked at Japan's vulnerability and thought, no way are we letting that happen to us. So what are they doing? They're building an exit door. They've been methodically dumping U.S. treasuries. They've gone from $1.3 trillion down to $800 billion. That is $500 billion completely sold off quietly and deliberately, just to ensure they never get trapped in that same cage that crushed Japan.
Moving right along to Section 2, the 1944 Reserve Playbook and displacing financial dominance.
It's really easy to forget that America didn't just stumble into global financial dominance by accident. They engineered it. Right before the 1944 Bretton Woods Conference, America executed these 5 very deliberate steps to quietly dethrone Britain's pound sterling. First, they became the world's largest creditor. Second, they accumulated roughly 70% of the world's gold. Third, they built up Wall Street to rival London. Fourth, they just waited for Britain to exhaust itself financially through the war. And finally, when Britain was at its absolute maximum weakness, America executed a brand new global architecture with the US dollar sitting right at the absolute center. And here is the absolute wildest part, the eerie parallel. China is literally replicating every single one of those exact steps right now. Step 1, over $1 trillion in Belt and Road loans, making them a massive global creditor. Step 2, they're accumulating massive gold reserves. Officially, it's over 2,000 tons, but it's likely much more than that. Mainly because, gold can't be sanctioned or frozen. Step 3, they're building alternative financial infrastructure, like the SIP system to rival SWIFT. And steps 4 and 5, striking petro-yuan agreements and just patiently waiting out the US debt spiral. They're meticulously creating the exact conditions for a new global financial architecture, and they're doing the whole shebang without firing a single shot.
Okay, let's pivot to Section 3, the 1875 debt collapse, or the math of the internal empire.
Let's take a look at China's internal vulnerabilities for a second, because they actually mirror the Ottoman Empire perfectly. The Ottomans didn't collapse in 1875 because of military weakness. They collapsed from structural arithmetic. Imagine a household where the credit card interest is growing way faster than the actual monthly paycheck. That was the Ottomans in the 1870s. They borrowed incredibly heavily to modernize, but when a bad harvest hit, the gap between what they owed and what they earned just forced a bankruptcy. It eventually stripped away their sovereignty and handed it right over to European bondholders.
So to understand China's looming revenue crisis today, we really need to talk about LJF fees, or local government financing vehicles. See, because local governments in China couldn't borrow directly, they essentially opened up these massive, secret, off-balance sheet credit cards to fund infrastructure and property development. And today, those hidden entities hold a staggering $9 trillion in debt.
When you actually stack all these hidden credit cards together, the LGFVs, the imploding property sector, state-owned enterprises, their true consolidated debt to GDP ratio is nearing 300%. And here is where that Ottoman parallel really hits hard. China built this giant mountain of debt assuming endless land sales would just pay it all off. But land revenues recently plummeted by over 40%. The money they need just to pay the interest, it's vanished. China is now facing this massive Ottoman-style gap between what it owes and what it earns. It's creating severe internal fragility right at the exact moment they're trying to project power externally.
Which brings us to our final section, number 4, the 1929 asset grab and structural arithmetic at home. All right, let's bring this whole story right back home to your wallet. Back in 1929, commercial banks really blurred the lines between keeping their depositors' money safe and selling those same depositors risky securities that the bank itself had actually underwritten. So when the crash happened, the banks absorbed all these assets at distressed prices, while everyday retail clients lost everything. That massive conflict of interest was later outlawed by Glass-Steagall, basically a wall built between your boring savings and Wall Street's risky casino. But look at 2025. Today we have BlackRock. They are simultaneously managing passive retail index funds, voting the shares of almost every major American corporation, providing risk advisory services to those exact same corporations, and even advising the Federal Reserve. The conflict of interest has completely returned. It's just wrapped up in a modernized structure.
But it's the sheer scale of this that's just mind-blowing. At its absolute peak in 1929, the largest bank managed about $2 billion. BlackRock today, $11.5 trillion. Through their Aladdin risk management platform, they track over $20 trillion in assets. Because of this incredible volume of money just mechanically flowing into their index funds every day, BlackRock becomes the largest shareholder in the majority of S&P 500 companies. It's literally a mathematically inevitable asset grab, and it's happening continuously, not through some sudden market crash, but through pure automated structure.
And here is the real catch for us. Retail investors, meaning you through your 401k or your pension, you technically own the market through these passive funds. But you don't get to vote, you don't get to choose the corporate boards. The structural voting power, the governance, and the immense flow of inside information go entirely to a single manager. You have zero visibility into how your ownership is actually being leveraged. The information asymmetry here, it is structurally identical to 1929.
So let's take a step back for a second. From the Ottoman collapse in 1875 to the 1929 bank asset grab to the 1944 reserve transition, right up to the 1985 Plaza Accord, the invisible forces that are shaping our world right now, all the way from Beijing to Wall Street, they are not random accidents. They are exact structural replicas executing right in front of us.
I really want to leave you with this final thought to chew on for your own savings and our global future. When we see the absolute mathematical inevitability of these historical playbooks running today, does regulation actually have the power to stop it, or are we simply waiting for the structure to inevitably break all over again? Keep your eyes on the math, folks. Thanks so much for joining me for this explainer.